All right. Good morning, everybody. Keep your eye on the clock at 8 a.m. Bloomberg's having an interview with Scott Bissett and the other guy, his name Lighthouser, the trade guy that has been appointed. Okay, well, it looks like they already finished with Bissett, but the other guy, they're going to have him on at 8. And there's talks about this EU. He was trying to push back, and Scott Bissett saying, "Oh, it's just a negotiating tactic, retaliation." That's the word I was looking for. So the EU is talking about retaliation, and Bissett says, "No, they're not going to retaliate. They're just saying they're going to retaliate as a negotiating tactic." Yeah, well, you know, how many times can you kick a dog before the dog wants to bite you? If Europe is the dog in this scenario, you know, they're going to get tired of playing nice if they just keep getting kicked over and over. We'll see if they have any teeth. So, yeah, keep your eye on the clock, right? It's not something new. Should be keeping your eye on the clock anyways. It's one of the best trading tools you could ever use, and it's free. It's on every device. We have a significant discrepancy between the Nasdaq and the S&P this morning. So that's another one to really keep your eye on. It doesn't look like much here, but when you're looking at it on the charts, there's quite a bit of difference between the ES hitting yesterday's high and the Nasdaq unable to even get to the RTH high of yesterday, right? So quite a bit of difference there. If the tech and the Mag 7 hyperscalers are supposed to be the dominant market moves, right? They're the ones with all the weight. Uh, they're not leading this market today. So someone else is driving the boat. Hong Kong basically flat with Japan, just on opposite sides of the coin. Still not really getting much out of it. UK's up, maybe because they're growing a backbone. And we really don't have much on the home front. Existing home sales. It's not to say that these home sales don't matter. Just look at the numbers. They're really close together. Not really expecting anything. And we have the auction today. So 20-year bond auction. Not that we have favorites, but I do like this one. So 1 o'clock today, keep your eye on it. And of course, it's Wednesday, so we have the crude oil inventory numbers. Want to see where our stockpiles are at, and there shouldn't be, a significant change. But we're seeing a bit of a discrepancy here between previous and consensus. So let's see how far off we are. That can cause a little bit of woe this morning, especially since hyperscalers are taking a back seat. Yeah, you know. He didn't talk very long, all things considered. He likes to ramble on and chip his teeth, so I don't know why he cut the interview short. The dollar below 97.5. These have been pretty significant and quick moves. Kind of want it to slow down a little bit, take it easy, but it has been consistent and persistent. One of the things you want to keep your eye on is the distance between each new leg. So that's 0.71, 0.62. If it was increasing, you'd be a little concerned, right? A little off the top. 0.68, 69. So yeah, between the first one and the second one, it increased a little, then it started to slow back down. If we get another leg down, it should match the previous level, just come in a little bit shy if it's slowing, or it'll exceed this 0.72 if it's expanding. The distance between each new leg down matters, and so does how far we pull back. but the pullback, a lot of times isn't as important as the next leg. And of course, if we are going to turn this around, we need to start making higher highs and higher lows. The call wall was rolled back up to where it was, which implies that the roll down that we saw yesterday was just a mechanical function of the machine checking to see where the next location was after something expired. And that's different than seeing a bunch of positioning come in and adjusting the call wall. So I wouldn't pay too much attention to the call wall being rolled up at this point, especially since it just went back to where it was. If we find it rolled up again tomorrow and then again above that, then, we can start to consider that they're positioning the call wall higher. Overnight volume is good, 65, 66. It's definitely more than we've seen, when we were in the 40s on Monday or 60 yesterday. So it's doing a little bit better, but we're still maintaining this range, right? You can see yesterday with those higher highs and higher lows, just a consistent, persistent march, right? Back up to Monday's high, which was a nice short this morning. Hopefully it took advantage of that. We didn't go far, but if you have enough contracts, you don't need it to. Still holding above the volatility trigger is zero gamma, 10-day, 3-week, 20-day. We're above everything, right? We're above all the averages and we're in pretty much clear skies. We just have to get through this 63.74 zone. We have clear skies as in relation to the moving averages, that there's nothing overhead that we could hit. Now, if you start thinking about what other things may be up there, right? There's some bands up there. And then there's expected move levels that are up there. And those do have weight. They do have context to them, but they're far enough away at this point that we don't need to be too concerned with them. All right, so we have hit the ADR half, and there's an old phrase that I use quite a bit. If we hit the ADR half early enough in the day, we can go to the other half by the end of the day. This isn't about being bearish or bullish. It's just a market function or a market reaction, right? It's the way price moves. The thing is how early we hit it, and the trading day is half done already, right? I know if you're new to trading, maybe you're not grasping that logic yet, but trading started last night at 6:00 p.m. It is past 6 a.m. this morning, so half the trading day is done, and you slept through most of it. Anything of that? Yeah. On the other hand, with that same logic, a lot of times, if we're going to go from one side to the other, generally we get there and then we reject and we go. We start working in that other direction. We didn't do that. We got there and we've just been kind of hanging out. So we could go to the other side by the end of the day, but I'd want to start to see that manifest with some price action, right? So let's get a lower high here and then break this low with a new low so we can get a lower low and a lower high. We need 2 of those to define a new trend. So if we can set one there and then set one here, once we set that, run back up again and set another one. Okay, so we're talking about something that looks a bit like that. And then break this one with a new one. That'd be 2 lower highs and 2 lower lows, and that is the very definition of trend, right? It's a full set, Right now, we don't have a full set. We don't even have a set, let alone a full set. Beyond that, though, if we can get back up and break our own Globex high, that's also going to put us above this Monday's price action that we talked about yesterday, all that volume that was sitting up there. If we can cut through all of that, then we have the full ADR on the table, 63.97, which is really close to 6,400, and I don't see why we wouldn't go up and take it. It's a big options level up there. I know it doesn't show up in the spot gamma stuff, but you should always treat quarterly levels as big options levels. So 6,400, 6,375, 6,350. It goes back to what Tom Sosnoff talks about, right? He's the big, really smart guy that created Thinkorswim and Tasty Trade, and guy's just really smart, right? He's been in the industry for a long, long time, and he's talked about how a lot of traders just hate math. They suck at math, and then you throw options at them, which is even more math, and they will by default trade round numbers and quarterly levels like 25, 50, 75, 100, just because the math is easier. As silly as that sounds, if you go in and you look at the options flow and where a lot of open interest lands, he's not wrong. So pay particular attention to those levels. Not just for the ES, right? But if it was SPY, it'd be like, 725, 750, 775, or the Qs, whatever. Just always pay attention to those quarter levels. So we are inside day breakout. It's one of the things worth paying particular attention to today, besides the ADR levels. For things to begin to get bad, we would have to fall all the way back down and break below 63.50. Let's just round that a little bit and get back inside of yesterday's price action. As long as we're outside of that zone, the market's not even going to consider any downward move bad, right? So we could fade from where we're at a good 20 points. Market wouldn't even care, right? We would not be considered bearish at that point. We'd have to break back inside of yesterday's range, break the mid of that range before even a thought of being bearish would show up, and we'd have to break yesterday's low before we'd really see a market consider some short opportunities. That's when we'd see more of the options flow begin to kick in and join the downward move, right? They'll begin to monetize short trades. We had 3 days where there was a lot of selling pressure above 63.50, right? See the wicks here, here, and here. That every time we got up there, it was just sellers waiting. And the question yesterday was, are there any sellers left up here? Looking at the price action so far today, the answer is no. We finally removed all of them, and now price has to go higher to find somebody else willing to sell up there. But we saw this same push on Monday, and we weren't able to keep it, and we came back down again. To be fair, though, that was one-time framing, and it left a bit of a liquidity vacuum behind, right? Weak levels that didn't hold up price, and we weren't able to keep it. If you look at the way we worked back up there, this is a more sustainable move because it worked its way back up rather than just having this slingshot up. And when you have price action that works its way up like this, it's stronger than having these really weak, thin levels like this. So our zone this morning is our own Globex range. GTFO, we got to get out of that. If we can get out of our Globex range, then we've got something to work on. So that would be a break to the upside into 63.97, or breaking that Globex low, challenging yesterday's mid price, and then focusing on yesterday's low. 63.32 cog line, and then yesterday's low lines up with the ADR half on the downside. Then you got the 11s and then the 23, which is 63.11 cog line, and then 6,300 flat. 62.92 cog line underneath that. No reason to think that we're going to get bearish at this point. We could go down and hit the lower edge today. That would not be bearish. We continue to hear about all this money that is sitting on the sidelines, ready to be deployed into the market. And that's something that should get your attention, right? If we've moved this far off of those April lows, and we did it when there's still a massive amount of capital sitting on the sidelines because of, well, like I mentioned the other day, a lot of analysts kept saying that this was just a bear market rally and that we were going to fall back down again, right? Because in bear markets, you can get those really steep pops. So we were down here and we started to run, and they kept saying, oh, it's just a pop in a bear market. And they said that all the way back up to 6,000. Then they started to get long. So if there's a lot of money left to be deployed and that money decides we actually are bullish and then they hop in, you're looking at 67, right? By the end of the quarter or into the next quarter before the end of the year. Just like the analysts were calling it the first of the year, 7,000, 7,200. We could do that easy by 2026. So as much as there's bricks in the wall of worry and everybody continues to chip their teeth about warning signs and overbought and overextended and blah blah blah, there's still a lot of capital waiting to go. So if they clear up this tariff talk and remove some of those bricks from the wall of worry, we could really start to get it done. More immediately, though, let's just focus on the range for today. Get out of the Globex range, get that expansion to the upside, or get out of the range, test the mid, and work on the lower levels. Pretty much as simple as that. We still have all those really big events next week. So if we start to break out today, you still have to have the question of why are they willing to front run with a lot of money in front of those big events next week? It's very likely going to be some short-term trades. Today's floor pivot is lower than yesterday's, and that's bearish. Price opened above it, that's bullish, kind of cancels each other out. Today's channel is wider than yesterday's, and a wide channel implies that if we break out, that it doesn't stick. Well, so far we have broke out and it's sticking, right? We haven't given it back yet. We also have an MDP at this point. It's a missed daily pivot. That purple line down there is the daily pivot, and we didn't hit it yet. Markets generally hit their pivot. So the fact that we haven't hit it kind of implies that we need to go down there and get that done. But we miss them, and we start to count them when we miss. It won't count today. We have to go through the entire day without hitting it. Then we would look back tomorrow at today's pivot. We'd say, hey, we didn't hit that pivot yesterday. Then it would be a missed daily pivot. But so far we have one, and we want to keep our eye on that. We challenged the pivot channel last night, wasn't able to keep it. And off of that, we had this little spike here. It's a micro gap, like a liquidity gap, but it's not a very big one. Didn't have a lot of push with it. So we'll see what comes of it. But you can mark the level. It's so close to 63.50 anyways that I wouldn't get too hung up on it. We got close enough to R2 that you can go ahead and count it. I know, there's some analysts out there that are really particular and they won't count it unless you actually got to it. And I'd say that was close enough. Remember, it's just math formulas, right? It's all just a bunch of math. So if we did make R2 and we're moving away from it now, then that puts S1 on the table. That's 63.26. It's all the way down here. I know, I get it. I'm not saying we're going there, just that we easily could go there. It's within yesterday's range. So, if you think about the lower ADR and how far we could travel today, we could easily get to that level and we still wouldn't be bearish, right? All things considered, you know what I mean? Like, that still wouldn't put us in a bearish bias or activate any short triggers or anything like that. Otherwise, if we do get through the R2 and continue to drive, then we've got R3 at 64.10, which is really close to 64.11 cog line and would be the better number to focus on anyways. One thing that I like to do when it comes to these pivot points is zoom out a little bit so that I can see the previous day's range. You can see the previous day's range is this big and today's range is this big. The reason I bring that up is if you've read the pivot points book or anything like that, they talk about how R1 can lead to S2 or S1 can lead to R2. Getting to R2 offers an S1, right? All those things that I just talked about. But what they don't really bring up in context is how wide is the range today? If we zoom out, the range can get really big sometimes, right? Like really big, because it's all based on what we did the previous day. So some of these ranges can be that wide. And that's not a broken indicator. That's how wide the range was that day. Let's put it back and look at that range in context with today's price. See the difference, right? So when they talk about these R levels and S levels and how we can play these ranges, they never bring this point up, that you really do want to have an idea how big is the range in comparison with what we've done recently and how far price could go compared to something like its ADR. Because just getting to an R1 or an S1 when the range is really big like this is a major milestone on the day. And of course, it's all revolving around volatility, right? In a higher volatility environment, we will move further because volatility is just another word for movement. High volatility, bigger moves. Low volatility, smaller moves. Implied volatility is promised moves or promise of big moves. So we could get to R3 today. There is a math formula. I didn't mark the line, but you could get it online for the R4 and R5. And then there's mids, like there's a R3.5 and R2.5, right? There's half levels in between these levels. It's all math. You can get the formula. So if we got wild today and we broke R3 and continued to move higher, just hit me up. I'll get the lines, or you can jump online and find them. It's rare that you need them, right? Really rare. 63.26 would be the S1. And it's still inside of yesterday's range. We are building out a second distribution at this point. It's that high volume node that we were looking at yesterday. And of course, we've put more work into it. So we're really building it out. It won't surprise me if we end up building out this entire zone and that this becomes the distribution with the point of control more centered into the middle. And that at that point, once we break below, say, the 32 cog line, then we'd get into this shallow zone back here. So the risk really starts to pile up below the 32 cog, which is just above this value area low here. Ten-day, 30-minute TPO and volume profile. We still have a bit of a discrepancy with this volume shelf here and the lack of one here. But the point of controls are really close to being in the same spot. And we're building out a nice level up here, but we're not really seeing that distribution here yet. We're not going to see this point of control move up for at least another week still. So for the entire week, it should stay where it is. And, worst come to worst, we're going to go back down there into that 63.10 area. And we're going to put more work in from here, which means we'd have to get rid of all these candles, cover the gap, and then get rid of the new candles from that location. So we'll see how much work they put in if we get back down to that 63.10 area. But that's just like a big safety net sitting underneath the market. So if we did start to sell off, unless it's got some really negative news behind it, this is going to catch us on a drop. We did hit that VPOC level from Monday, but we hit it in the overnight. For me, that's it. I'm done. I don't want it anymore. But the textbooks would tell you to keep it on the chart for the whole day, that it is a level that still matters, especially since we hit it in Globex, and that we could revisit it again in regular trading hours, and that you might actually see more responses at that level. I'm not too interested in it. I'm going to keep it on there. Just it's not a VPOC anymore, so I'm going to change the style of it just for context. So now it's just a point of control. It's a bit different. We don't have a new VPOC from yesterday because we cut that level at the open, and then we ran back up through it when we had that liquidity spike. So I'm not marking that one. But again, the books will tell you to mark these levels every day, right? The book doesn't even mention the VPOC at all, and is a more modern concept than what you get out of the books anyways. Not much of a discrepancy between today's profile and TPO either at this point. It's just an ugly distribution. It's a scatter shot. Right? There's the weekly expected move. And at this point, since we're still within Monday's range, we haven't done anything on the week. The gray line is Friday's close. We're at least holding above that. But we've been unable to break Monday's range. If we can get through Monday's high, then we have the week's range overhead, 64.27, which is really close to 64.32 cog line. And I like that better than some random number like 27. Technically, we could get there today, but again, what would be the bias or the trigger, because we've got all those big events next week. So just keep your eye on Monday's high. If we break it, we could get one of these big blowout run kind of days. I know that doesn't seem very big in the context of where we're sitting right now, but big enough, right? Talking about just getting it through Monday's high and getting to this. That's nothing, right? We could easily do that. Yeah, it's not even a 1% move. So considering we're up, 0.4, and this would take, let's just round it and say 0.9, a combined move on the day of like 1.3%, we can easily move 1.3% in a day. We're still 3.5% above the 10-week, and we don't have any violent or extreme moves so far, so no warning sign here. Everything looks fine. And on the daily, 0.75% above the 10 it's just fine. We have a range of like 0.5%, and we've been consistently, holding out above that. So if we put it at 1%, we're still underneath that 1% level. We're not too far away from the 10-day. We're not overbought. We're not overextended. We haven't moved too far too fast, and it does not owe us any sort of a pullback. It's a thing that I focus on quite a bit when it comes to the VWAP, and it's called reciprocation. How far above or below the VWAP did we get? Because if we do break it and go to the other side, then that's how far I expect to go on the other side, which gets us back into like 63.55 for a downside move. And again, that wouldn't be bearish, right? That would just be price action. If we moved that high on the upside, we could move that high or that low on the downside, and it would just be matching those levels. Reciprocation. If we exceeded reciprocation and continued to move to the downside, then we'd have to consider, changing up the plan. But no reason to think it's going to get nasty out there. Remember, it's supposed to be a sideways week. So unless we get some real fire news that starts to spark us to the upside, or just something really bad that takes us down, then the range should continue to hold. With the tariff talks going on right now, I can't remember who they're interviewing. I think it's that Lighthouser at 8. The EU could be the catalyst. All right, the VIX is giving back what it took. The Mag 7 down volume is down. I know it's like a double negative and a little weird, but that's positive, all things considered. Bitcoin down a bit. Speaking of, Kathy Woods has 3 different ETFs that bought a bunch of Ethereum in a report filed after the close on Monday, I believe. Just thought I'd throw it out there. She got some Ethereum ETFs. So you might see that sort of liquidity by the end of the week, depending on what kind of metrics you use. Inflows on ETFs. China's up. There was an announcement about Alibaba unleashing a new coding model for developers so that they can push AI agent in the Alibaba system, right? So they're adding agents basically, which is another bonus for the China AI. And so China's up this morning. This one, that one, there's China again. There's some of those Kathy Wood models somewhere in here. Mag 7 up volume is up. China again. Surprisingly, the financials aren't up more. You know, I started this stream today with a focus on the Nasdaq versus the S&P and how the S&P was back to previous highs and the Nasdaq wasn't even back to yesterday's RTH high. And usually when you get this sort of discrepancy, it's because of financials. The Nasdaq 100 doesn't have financials in it, right? And the S&P does. So generally, if the S&P is outperforming, then you know it's like weighted versus unweighted. Um, that that needs to be clarified, but it's too early in the morning for that. It's not weighted versus unweighted in the idea that you could look at this other model. It's more weighted versus unweighted on the idea that the S&P has tech, the Nasdaq has tech, but when you compare Nasdaq versus the S&P, then you've got finance in one and you don't have finance in the other. Here's the weighted versus unweighted, right? We're not talking about that kind of model. But generally speaking, when you have the Mag 7 performing well, or just, you know, the dominant hyperscalers, then they run the market. And when they are underperforming, the market generally doesn't do well. So if the blue line here is going up, the Mag 7 is underperforming, and the pink line, which is the S&P, we tend to sell off. So the Nasdaq is underperforming today. When the Mag 7 takes a break and that blue line goes up, we usually see the Nasdaq sell off, right? Like back here. So it's moving up this morning. In fact, we got a big gap up this morning, but the Qs are not selling off yet. That's going to be the concern, right? If it's just a 1 day thing or a 2 day thing, it's not going to matter. But if this persists and we start to see the overcrowded Mag 7 group lose its dominance and take a backseat and start to underperform, then we could see more of the staples outperform. XLP, XLV, not necessarily XLU, because nowadays that's tied to tech and AI and all those. Normally we would include that. So this morning we basically got uranium, Mag 7 up volume, China, and Bitcoin. Not much Bitcoin. And Bissette's still chipping teeth somewhere. IWM is leading the indexes this morning. It's outperforming the S&P, the Qs, the Dow, everybody. And we've got China on top, utilities, then China again, uranium, healthcare. This isn't what you want for a rally day, right? If you're looking for, you know, a good sustained move to the upside, you want the Mag 7, consumer discretionary, tech, finance, preferably all three. But out of the three, finance is the minor one. So you can have, consumer discretionary in finance, or you can have tech in finance. You can have tech and consumer discretionary without finance. But you don't want finance without the other two. Solar's down with crude and nat gas, so that's a lot of energy. And Bitcoin, thought we had Bitcoin up in a different ETF, but that might have been an Ethereum ETF. Bitcoin down. Chips are down, but not enough. Keep your eye on those if they're starting to work their way back up, which they are. You can see they're coming up off of that low. That's the 20 period daily moving average that they hit yesterday. So if they keep this bounce, then the midpoint of yesterday is going to be the concern. $286. We got to get above 286 in SMH, or the shorts that we started yesterday in TSM and SMH and AMAT, all those chip shorts we put on yesterday, they're going to continue to do good if we can't get through this half point. If we get above it, then focus on yesterday's high, basically 290, right? We're talking about RTH high, not the full move of yesterday. And then back above that if we continue to push 293.5. One thing at a time, though. We got to get through this half. And if we don't, then we're just stair stepping, right? Get the drop, come back to the half, get the next drop, come back to the previous one, get the next drop. You get the idea. Lower high, lower lows, same stuff. Rinse and repeat. And bonds trying to take it back. They gave up quite a bit. They're fighting that 1020, but we had a 1020 cross, and we had price underneath both. So if we're trying to turn that around now, which I don't think we're going to be able to keep it, but if we can get it, then 86.5, and we try to challenge the year-to-date anchored VWAP at 88 if we can get through it. But, I mean, read the writing on the wall. It doesn't look good. Especially with the 10-year getting so stretched, that TNX, that downside stretch, if we do start to flip and it begins to run, which is what we would expect if it continues to fall too far and get out of line, if it flips and starts moving its way back up, then we're going to see bonds head down anyway. And at this point, keep looking at the S&P at these levels while the NASDAQ's not. You got to assume that, it's not finance that's doing it. We just saw that. So if it's not finance that got us here and it's not tech that got us here, then we're talking, FX markets, treasuries, commodities. So watch the dollar and the 10-year. Got the auction today at 1 o'clock. Be careful, be safe. I'll see y'all tomorrow.